Right, hello guys. This is a really fun section of IS2, net realizable value. This is where all the concepts and conservatism that we have been talking about is going to come to life for you. So I'm really super excited about the next few videos, and I'm really looking forward to chatting to you guys about it. I hope you enjoy it. Pull up the popcorn. This is going to be some really good stuff. Okay, we have a blank piece of paper. Every artist needs one before they start, and this net realizable value is pure art. So let's just recap what you guys already know. You would have had in your life some inventories that might have a cost price of R1,000. So I'm just going to write it on there, cost price R1,000. Then a teacher or a lecturer or somebody has told you that the NRV of those inventories is R800. Well, great stuff. So we know the basic measurement rule in IS2 is the lower of cost or net realizable value. So I need to do a write down to net realizable value, in this case of R200, because I want that lower amount. That's what I'm looking for. I want to measure my inventories at a lower amount. So something else you would know from the past, with perpetual inventories, we would have an inventories account in my statement of financial position, and that inventories account would have a balance at the end of the reporting period of R1,000. Okay, so that's in my GL. That's my general ledger balance. So you would physically now need to go and do a journal entry to write this thing down. So I'm going to create a debit. I'm going to create a credit. We need to write it down with R200. So to decrease an asset, we all know by now, we have to credit it. Inventories, credit R200. And where do I take the other side? Cost of sales. Anything to do with inventories gets dumped in the cost of sales line item in the statement of profit and loss and other comprehensive income. I still can't get over the name length that we are choosing to use these days. So there's some revision. Everybody should be happy. I hope you're feeling happy. I haven't entertained you yet. This is still boring, hey? Let me bore you for a moment more. Periodic. Periodic, what do we have? Inventories. SFP. That's right, nothing. Oh dear. Let's just type it properly for Excel's purposes. We have nothing. Thank you, Excel. We have nothing. Okay, periodic doesn't keep a running balance in the general ledger. What happened to these inventories? They were all lying in purchases, which is part of the cost of sales line item. They're all lying there at R1,000 at their costs. Then what do I need to do? Now I need to say, oh, you know what? I need to measure my inventories at the lower of cost or net realizable value. And I need to have closing inventories. These items are still on hand. So I want to deduct these out of there, and I'd really like to move them to my statement of financial position because they're still on hand. But wait, I can't take them at the cost price because the NRV, I need to measure my inventories at lower of cost or NRV, and the NRV is lower. I need that to be R800. So my closing inventories journal needs to be R800. What is the net effect there? R200 expense left in the income statement. We've just achieved the same with the periodic system as we would with the perpetual system. Do you see that? So with the perpetual system, we start with 1,000, we write it down with 200, I then get a balance at R800. Oh dear, this is frustrating. Right, there we go. So I have R800 balance now in my income statement over R200 expense. Let's go to periodic. What does my journal look like in periodic? Well, we're creating the inventories asset. I'm creating it at 800. I'm going to put through a journal against cost of sales for the 800. Okay, why am I doing that? I'm writing down what's already in cost of sales because I'm periodic. My purchases are already in cost of sales. I'm writing it down with 800. That leaves me with an expense of 200, and I've created the asset of 800. Both systems are giving you the same answer. Take a moment to look at that. Pause the screen. You've got assets under both systems at 800, and under both systems you're going to have cost of sales expense of 200 Rand. Right, you got the bookkeeping sorted out. That you know how to do. Let's get into the really fun stuff. And I want to help you understand conceptually what is going on here and why we're doing it. So, let's pick 2 years. Not going to pick 2020 for obvious reasons. So, let's move into 2021. I have inventories on hand for 1,000 Rand. Unsold. Those inventories I am recording at their cost price. They are lying there in my accounting records. Then life moves along into 2022. And I tell you that we have sold those inventories now. And we sold those inventories for 800 Rand. So that means I don't have the inventories on hand anymore. And what happens then is I record a cost of sales. Of 1,000 Rand. That's what those inventories cost. Cost of sales 1,000, and I am now making a gross loss of 200 Rand. So we had inventories in 2021 still on hand at cost at the end of the period of 1,000. I sold them for 800 Rand in 2022. So as things stood here, cost of sales would be 1,000, and I would write down to 200 Rand gross profit. Now you're feeling uneasy with this, aren't you? Because your instincts are already good and you're already saying, but no, there should be a net realizable value adjustment. And that's exactly right. But now that you see it like this, with these 2 years next to each other, you can see what the standard set is trying to achieve. Remember, this standard, we're super conservative. If I can recognize a loss, if I smell a loss, I'm going to recognize it. That's what they want to do in IS2. If I smell a loss, I want to recognize it. So, we can't have these inventories here at 1,000 in 2021, no losses, and then the loss the next year, because we already smell that loss. So what do? We write these inventories down to the 800 Rand already. And I recognize that 200 Rand NRV adjustment in cost of sales in 2021 already. Okay, how did I get that 200 there? It was the 1,000 cost price written down to net realizable value. Okay, so what is the impact on the next year? Let's take these numbers out. I have sold those inventories for 800 Rand. What is the book value of those inventories? What is the balance coming through from 2021? It's the 800. So we have them in our books at 800. In other words, next year, no gross profit. We've accelerated recognizing the loss a year earlier. Isn't that cool? That's exactly what net realizable value does. That is the whole point of net realizable value. Is as soon as you anticipate a loss, then you need to recognize the loss. So let's move into the accounting standards now, and let's have a look at some of the sentences in light of this, and then we can start really understanding why some of the rules are there and the kind of thing that they're looking at with those rules.